Welcome to Different Makes a Difference, where we discuss investment matters that matter to everyday investors. Join Odlum Brown's equity analysts as we examine pertinent topics in today's markets and look at things a little differently. Odlum Brown is an independent Canadian investment firm. We provide integrated wealth management solutions to help clients achieve their financial goals, and we've been doing so for over 100 years. Join us for some lessons we've learned along the way that can make a difference for the future.
Hello and welcome to Different Makes a Difference. I'm Stephen Boland. We've been hosting this podcast for nearly a year and a half, and we haven't yet talked in detail about the Canadian banks. That's somewhat surprising given their importance to Canadian investors. Looking at market cap, 5 of the largest 7 companies in Canada are banks. Royal Bank is the largest in the country. TD is number 2. Banking is a very important part of the economy. We almost all interact with banks regularly, and most investors have at least some exposure to the bank stocks through their investment portfolios. Owning Canadian bank stocks has been a good thing. They've been very good investments over the long run, and they've done extremely well lately. So let's get up to speed on Canadian banking. And to do so, I'm joined by Trevor Chang. Thanks for joining, Trevor.
Happy to be here.
So Trevor, can you start by giving us a lay of the land? What does the banking sector in Canada look like?
Yeah, so it's really 6 big banks that have the majority of the banking assets in this country. And the 6 banks are Royal Bank, TD Bank, Bank of Montreal, Scotiabank, National Bank, and CIBC. Banks in Canada are a little bit unique in that they're more profitable than the other banks around the world. They're all very diversified. They have personal and commercial banking, wealth management, capital markets, and some of them also have an insurance business too. They have historically been very stable dividend payers, and they augment that with share buybacks sometimes as well, especially when share prices are cheap.
So you say they are more profitable than most banks around the world. Why is that?
Well, one of the reasons I believe that to be the case is really due to high entry barriers and the fact that there's a lot of regulation in Canada. I guess the goal of the regulation isn't to prevent competition, but is to ensure that when an institution is a bank, that they are a trusted partner, provide stability for Canadians. Certainly, banking touches a lot of areas in our personal life with regards to money, and so you certainly want these institutions to be very safe.
Okay, so you want strong banks, and that means there's only a handful of big ones, and that means it's just less competitive, and they make pretty good money, I guess. So that partly explains why the stocks have been good investments over the long run. If I look at the last little while, they've been exceptional investments. And it might be somewhat surprising because in some of the big cities in Canada, think Toronto, think Vancouver, we've had a housing slowdown. Just a year ago, April, there was a lot of concern around tariffs and the impact on Canadians and Canadian businesses and the potential credit risk to banks. And here we are, and banks keep hitting new highs despite all of that. Why have the banks done so well recently?
Yeah, well, I think the Canadian banks are just really catching up to the global banks trade. I mean, if you look at bank stocks all over the world, whether it be in Europe, in the USA, I mean, they're all up a lot too. For a couple years, investors were concerned about macroeconomic issues, as you mentioned, things like trade and things like the real estate cycle, and sort of could there be a lot of mortgages going bad? Certainly, those concerns proved to be too much. People were way too concerned about it, and I think the banks actually have much stronger loan books than people thought. Credit performance has been more resilient than people believed, and that's why the banks have done so well.
Why is that? Why is there, I mean, tariffs perhaps haven't been quite as harmful in aggregate as expected. Canadian economy is still doing reasonably well. Unemployment's not super high. I guess that's part of the answer. But you know, housing market's been tough in places. So like, why is it that the banks aren't experiencing more troubles?
Yeah, I think the big reason that people are slowly realizing is that the Canadian banks actually have a very healthy customer base. They typically want customers that, are a little bit further on in their lives, have more financial assets and really are lower credit risk. These customers also have the opportunity for these banks to sell more services to. So, for example, if you had a mortgage, they want you to, use their credit card as well, and maybe engage in other financial services that they offer. So they curated a very healthy customer base, and that really goes a long way in helping their financial results just look so much better.
Okay, that makes sense. Okay, so far so good. The banks are doing quite well despite some of the risks that have been out there. Looking forward, what are some of the risks that you worry about?
Yeah, no, I think that's a fair question. And it's something that we think about deeply, especially for stocks that have done as well as the Canadian banks. I would say first, it's just, the valuations have risen a lot for these banks. Right now, as a group, they're at 17 and a half times compared to, 11.2 times, which was 3-year average.
And what's that? That's price to earnings multiple?
Price to earnings multiple, okay. Sorry, yes. And therefore, I mean, with a high valuation, it typically implies high expectations looking forward for these companies. So, with higher expectations, there's always a chance that these banks fail to live up to those expectations. I think there's still some risk on the economy. As you've mentioned before, unemployment rate has been pretty resilient in Canada, but with sort of the trade issues still unresolved in this country, CUSMA is under review right now. There could be a possibility that that transpires in an unfavorable way, and the unemployment rate could go up. That would certainly be bad for credit, and that would negatively impact the banks as well. I think another issue, maybe I see it a little bit less today, but it could be a longer term concern for the banks, is just the potential for rising competition. As we've mentioned before, the banks have a very healthy loan book right now. Credit issues aren't really showing up there, but credit issues are really showing up at the bank's competitors, these smaller, credit unions, or some of these alternative lenders. But if we fast forward a couple of years after some of these smaller institutions have resolved the problem, I think they can once again become more competitive, versus the banks and the various lending lines, and that could cause profits to compress, and certainly the financial performance to not be as good as it is today. Yeah. So these are sort of the things that we're thinking about.
Yeah, an increase in PE multiple, price to earnings multiple, from 11 to 17 that's a big increase. Why is 17 too high? I mean, relative to a lot of stocks out there, it's kind of sounds okay. I think the S&P 500, the US index, trades above 20. Banks have historically traded a lot lower than that. I heard this morning elsewhere that 9 to 13 has kind of been a historical range, and now they're at 17. Why do banks trade at this discounted valuation typically?
Yeah, I mean, look, I don't want to be the bearer of bad news, but the truth is the banking business is cyclical over time. You have to account for that in the valuation multiple. Banking, at the end of the day, entry barriers is not high. And so that is also something that, can potentially depress returns over time. And again, like, just knowing that risk is out there, you can't assign such a high multiple for these investments. I also want to note that, like, you compared it to the S&P 500, banks across the world use a lot of leverage in order to amplify their returns. The average company doesn't have as much leverage as a bank, so again, leverage is also something that you have to take into account. And when you combine all these factors together, that's why a 17 times multiple for a Canadian bank is considered high, even though the average company in the S&P 500 might be at 22.
Yeah, that's a good point. These are levered businesses, and anybody who invested in U.S. banks in 2007, 2008 can tell you full well that leverage in banks can bring risks. And it sounds like here in Canada, perhaps the industry is a little bit better than in the U.S., but maybe we can actually dig into that a little bit more. We've typically focused more on Canadian banks than U.S. banks. We have in the past recommended JP Morgan. We don't currently, but why have you tended to focus or why have we tended to recommend Canadian banks over US banks?
Yeah, we just think that when you look at Canadian banks as a group compared to the US banks as a group, the Canadian banks are just more profitable. In the US, the banks are more exposed to the yield curve. So if the yield curve is steeper, that benefits the financial results for the US banks more than the Canadian banks. I think the yield curve has gotten more steeper over time, but it's really hard to handicap. And certainly, I think at these elevated valuations, it's just maybe not a risk we want to have exposure to. You know, when we compare
Playing the yield curve does bring in more risk, doesn't it?
totally,
Yeah.
yes. I mean, if the shape of the yield curve changes unfavorably for various reasons, and oftentimes it's a surprise, then the financial results do get hurt.
Yeah, and shape of the yield curve refers to short-term interest rates versus long-term interest rates. And they make a lot more off fees as well, don't they, the Canadians?
Oh, yes, they do. Yeah, and that's part of the reason why they're more profitable.
Yeah. Yeah, I've heard before that if you don't like the fees you're paying banks, we sometimes feel we're all getting nickel and dime. A way around that is to actually own the bank stocks and try to get your little bit of a cut back that way. Okay, so advantages there for some of the Canadian banks versus the US banks. What do you think of the Canadian bank stocks here? We talked about some valuation risk. They've gone up a lot, but they're still great businesses. How do we bring all this together? What should people be doing about Canadian banks today?
Yeah, I think they're still a core holding for us. We don't like them as much as we once did. That's why we're underweight relative to the indices. We've been trying to find opportunities at the margin. We've had 2 episodes on other financial companies, Progressive and Moody's, and certainly those are areas that we do find value. But there's just nothing super obvious out there, and therefore we just can't make a wholesale sale out of Canadian banks to buy something else. We think that probably be the wrong move to make. So, having said all that, that's why we have an underweight position.
Right. So still good businesses, solid holdings. But, when you say underweight, I believe in Canada, the stock market has about 20 to 25% exposure to Canadian banks. And we're advocating to have a lower position than that. That's a pretty big exposure to a sector where maybe the risk and return is not quite what it once was. Let's look at specific banks. What are your favorites?
Yeah, so our top 3 are Royal Bank, TD, and BMO. For Royal Bank, we just think it's a fantastic banking franchise, very stable, very conservative lending, highly disciplined, incredibly profitable. We really don't see how you can go wrong with Royal because they're so conservative. The stock probably doesn't do as well on the up days, but certainly on the down days it also outperforms. So we really like the stability of a Royal Bank. TD Bank is actually a very interesting opportunity. A couple of years ago, they got into some trouble with anti-money laundering. They didn't have the right controls in place. As a result, the regulators imposed an asset cap on their U.S. business. So for the past couple of years, they've just been doing a lot of reorganization, improving the operations of the business. In the U.S., they've let some loans run off. They've sold some other loans, and then now they're making new loans, but those are loans that are higher quality. They've also done a lot of cost cutting in the U.S. to really just make the business more efficient down there. if you track TD's US profitability, it's been improving. But because of the asset cap in the US, more and more of this business will be from Canada going forward. Like the mix of the business will be more from Canada. And the Canadian operation for TD is actually very profitable. And so what that means overall is that this business will become more profitable because the Canadian business will become bigger as a percentage of the total business. And that's really exciting in our view. They have a lot of excess capital. They've been buying back shares aggressively. They're not going down to the US and making these expensive acquisitions anymore in search of growth. Instead, they're just really focusing on themselves, improving their business, returning excess capital back to shareholders. We just think it's a wonderful combination of attributes, and we really like TD Bank. For BMO, a similar story. A couple years ago, some of their transportation loans went sour. Again, they're reorganizing that business as well. They're improving as well. But I think when we just look at what the potential improvement can look like for TD versus BMO, we think TD probably has the edge. And so that's why we just like it a little bit more than BMO. But certainly, I think all three of these banks are very good.
Okay, thanks, Trevor. That was a great discussion of Canadian banking. Thanks for sharing your views. These are very good businesses. They're highly profitable. They have a long history of generating strong shareholder returns, and they pay solid dividends. The Canadian banks have shown impressive resilience to recent macro challenges, including to falling housing prices in some major Canadian cities. These are positive attributes, but investors are paying a higher than usual price for them. And banking is still a cyclical industry that carries some risk. When we put it all together, we think of Canadian banks as core holdings for investors, but we believe that an underweight position versus the broader stock market makes sense right now. Thank you for listening. We hope you enjoyed this episode. Hope you're having a good summer, and we'll talk again soon. Thank you.
Thank you for listening to another episode of Different Makes a Difference. Just as every individual is unique, so are your financial circumstances. Be sure to talk to your professional advisors for advice related specifically to you. Our podcast is for general information purposes for Canadians only. The views expressed are those of the presenters and may not reflect the opinions of Odlum Brown. Be sure to check out our full disclaimer and subscribe to the podcast at odlumbrown.com/differentmakesadifference. Odlum Brown is a member of the Canadian Investor Protection Fund.